Hi, everyone, and welcome to another episode of UBS Trending. I'm Anthony Pastore. Thanks for joining us. The housing market in the U.S. this year has been anything but predictable. Higher interest rates and home equity loans have certainly put some potential buyers and renovators on pause. So what is the state of housing, and what might 2023 bring? Let's chat about that right now with my guest, John Woloshin, U.S. real estate and lodging analyst with the Chief Investment Office right here at UBS. John, great to see you.
Oh, thanks for having me, Anthony. I appreciate it.
Anytime. So listen, John, this is what a hot topic. I mean, you really can't talk about housing enough, especially in the last year and more specifically the last couple of months as interest rates have skyrocketed. So we've certainly seen that be a real issue here. But let me ask you as we get started here, John, what is the state of the housing market right now? And do you think, I mean, this is probably the question you're getting a lot. Do you think we're on the cusp of a 2008 style meltdown? Because that's probably the most recent housing situation that we can all remember.
Sure. Let me hit the second part first. The answer is no. We are not. Is the housing market slowing? That's probably one of the more obvious things that we can say here. What does slowing mean to us? It means a few things. The rate of price appreciation is clearly slowing and slowing dramatically. Some markets will see and are seeing outright price declines. Now, before anybody gets too concerned about that, those declines are coming off incredibly high values that have moved in very significant rate over a fairly short period of time. That's number one. Number two, the rate of sales, whether it's existing homes, new homes, is slowing. And number three, the rate of housing starts, particularly single-family housing starts, which is what most people think about when they have the housing market, is slowing. So all that should not be surprising. We're coming off an incredibly distorted period by COVID, number one. And number two, when you have mortgage rates that go up 300 to 400 basis points in a very short amount of time, it's not surprising it's slowing. But I think it's crucially important to separate a slowdown from what we saw in 2008, 2009, and we can certainly go into those details. But an emphatic no, we are not on the cusp of another meltdown.
That's good to hear, John. And you know what? And you make a really good point. According to the National Association of Realtors, home prices skyrocketed 45% between January 2020 and June 2022. So you're right. I mean, we're coming off of extremely high levels. So yes, prices are down, but still way above those pre-pandemic levels. And I think anybody who's looking for a house right now can certainly attest to that. But here's a question, because you and I talked about this during the middle of the pandemic. Are people still leaving the big metropolitan areas like right here in New York or San Francisco, LA, like in the early days of the pandemic, or are people starting to come back to the cities? Because I don't know about you, but me coming into New York the last couple of months, it feels like it's more crowded than it's ever been.
Yeah, it's a good question. I think there's two phenomena that we need to talk about. There is the structural population and job shifts that have been going on for quite a while versus what I'll call the more tactical outflows due to COVID. Let me start with the structural shifts. Those shifts that are being driven largely by economics, politics, and policy. Those have been going on, and we track the data back to 2010, and you've seen a significant outflow of population, jobs, but not just population, but it's high income, high earners, high wealth people who are leaving predominantly 5 states. That's New York, New Jersey, Connecticut, Illinois, and California. And they're going to a number of states. The 2 biggest beneficiaries obviously have been Texas and Florida, but you're seeing really kind of the Southeast, the Southwest, and the Mountain West markets being the biggest beneficiaries. Those trends continue. Now, what I call the more tactical outflows, if you will. If you look at the data, especially the mail forwarding data during COVID, out of Los Angeles, out of San Francisco, and out of New York, it was very interesting. I don't want to tell you that there was no strategic outflows, and people who are, have the ability to work remotely full time, a fair amount of them did move, but a lot of the people who moved on a tactical basis, say in New York, you saw a lot of mail forwarding to northern New Jersey, Westchester County, Fairfield County, Connecticut, Long Island, i.e. very close to the city, San Francisco, maybe as far as Sacramento. Now, if you walk around New York today, other than physical occupancy of office buildings, you would never know that there was a pandemic. San Francisco has been a little bit different. San Francisco obviously has much more tech exposure, and so that market has been slower to come back. LA, we're starting to see a pickup in COVID numbers again, what's unfortunate. So I think it varies by city somewhat. But if you look, and I'm going to again focus on New York, which was certainly a market that was hit very hard. If you look at the real estate data out of New York, and we recently published a piece on this, the rental market went from roughly 2% vacancy upwards of 10 or 12% vacancy back to sub 2%. Rents are near all-time highs. The sales market has slowed somewhat, but is still very, very strong. And so I think it is important to separate that strategic shift from the tactical shift.
Terrific, John. Yeah, I mean, as I said, I work in New York City, right where we are in this studio, and the streets are crowded. The subways are more crowded, so it feels like people are coming back. So it's a really interesting time. All right, so let me switch gears with you. Something that I think is a really interesting topic that is connected to the home buying side of the business is renovations. A lot of people are seemingly interested in doing renovations. We have a survey here at UBS called Medallia, and it asks, what are some of your life choices or things that are going on in your personal life? Home buying and renovations are the top two, and they have been for a couple of months now. So with rates where they are, this mortgage, 30-year mortgage around 7%, and these tight supply chains when it comes to homes and availability, do you think people are starting to think about refreshing their homes and doing renovations rather than moving? What do you think the interest here is?
Yeah, so it's interesting. We had a huge uptick in R&R, short for it, repair and remodel. We had a huge uptick in R&R activity during COVID. People couldn't go anywhere, and thankfully the home improvement stores, particularly the large chains, remained open. And so you had people said, well, I'm basically either fortunate enough to have kept my job or getting paid to stay home. So I'm going to put money into my house. Then things began to loosen up, and you started to see people migrate their spending from goods to services. The revenge travel, people call it, getting out, going traveling, going to restaurants, what have you. And so we did see a slowdown in R&R activity. But then as interest rates started to back up again, and backed up very, very quickly and very, very sharply, all of a sudden people who were considering selling, their first port of call was to say, oh, wow, I'm missing the peak. I better put my house on the market. And then when they saw the activity became, obviously affordability became very, very challenged, they said, you know what? I'm sitting here on a 3% mortgage. Why am I going to force my hand to go back into a 7% mortgage? And so we're seeing a small pickup in R&R activity. Now, it's important to understand that we've seen a tremendous amount of inflation due to, among other things, supply chain disruptions. So, I mean, this is a little wonky, and I apologize, but if we inflation adjust those R&R numbers, it is probably not as robust as it seems, but nonetheless, people who are sitting there saying, well, I'm not going to sell my house, I'm not going to buy a new house, so yeah, I'll probably put money into my house. So while we don't think it will be as robust as we saw during that early days of COVID through maybe 2021, we think it'll be a decent amount because, for most of us, a home is the single largest asset we'll own, and we want to make it nice. We want to make sure it's up to date and things work well.
Absolutely. I myself just did a home renovation in the summer. It's something I've been planning on doing for a long time, and it's great. And it feels like I live in a new home, despite the fact that I didn't have to get a new place at a 7% mortgage rate. So thanks for that, John. Good stuff. So as we're wrapping up, I know you also cover lodging within your coverage space at CIO. So is this a good time for equity investors to consider consumer discretionary? And of course, we're talking here about home builders and lodging. What are you recommending?
Yeah, so we have a cautious view on the consumer discretionary space, and within consumer discretionary, which is a very, very large sector, my subsectors, as you mentioned, are home builders and lodging. We're pretty cautious on the home builders. The stocks certainly screen cheap based on a price to earnings or a price to book basis. We had one of the large national luxury builders report earnings yesterday, and they were, whether you want to call them better than expected, less worse than expected, and the stock had a very nice move, and they sell at a very high price point. But, look, senior management, who we think is an excellent management team, said, if you boil it down to what they said was, we don't have a heck of a lot of visibility. And our one concern with the home building stocks is, yes, they screen cheap, but if volume continues to fall off, then there's going to be a negative impact on gross margins, and bottom line, that will translate into earnings or declining earnings, and they may not be as cheap as they appear. Now, to the credit of the large national home builders, they've done an outstanding job of being capital efficient, keeping debt low, so they're in very good shape, much better shape than they were in the 2006, 2007 period leading up to the global financial crisis. So we don't think we're staring down the barrel of any true financial problems, but we're still a little bit cautious there. The lodging side of it, we prefer the asset light companies over the asset heavy, and what I mean by that is you have a whole group of stocks, most predominantly they trade more in the REIT sector. They actually own the physical hotels, whereas the asset light of the management companies, and these would be some of the larger names that you would expect to see. They are really big beneficiaries of not only this revenge travel in leisure travel and also very high end travel, but there's a couple of other phenomenons that have been boosting them. And we'll have to see how things go with a potential slowdown in the economy. But what's called business transient or traditional business travel is starting to come back. Number one, group travel. Group travel had been rebounding, starting with, what they call more social gathering, weddings, bar mitzvahs, what have you. And we're starting to see more traditional group travel that is being put on the books for 23 and 24. And the last is international travel, but particularly in Asia. Now, we've seen a tremendous amount of international travel into Europe, particularly with the weaker euro. Europe's been a huge beneficiary of outbound travel into Europe. But Asia's been the issue, particularly in China and Japan, due to very stringent COVID policies. Now, it's anybody's guess as to how China handles this, but that will be certainly a big area of growth and profitability based on how those contracts are structured. So, look, the stocks have had a very nice rebound. They're certainly nowhere near as cheap as they were. So we have selective positive views within the sector.
Terrific. John, thank you very much. Always good to get your rundown on what's going on out there, especially when it comes to housing. It's a great story that's happening right now. John Walliston, U.S. real estate and lodging analyst. Thank you, John.
Thank you, Anthony. Always a pleasure.
Yeah, we'll see you soon. And for more information, everybody, you can visit our website at ubs.com/views and also follow us on social media. We're on all the platforms like LinkedIn, Facebook, Instagram, and Twitter. Plus, all of our UBS Trending episodes that have taken place in the past are available for you on demand. And as always, if you do have any questions about your portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everyone, and remember to keep your eyes on what's trending. See you soon.